Welcome, guys. In this video, we'll be talking about financial ratios. In the last sessions, we have covered how to do technical analysis and fundamental analysis, how to read balance sheet, cash flow, and profit and loss statement. And now we'll look at the ratios. So, in order to quantify financial statements, we use financial ratios, and it helps investor analysts to make informed decisions. So you can compare a company with its peers when you're looking at the ratios. Like, okay, this is the operating profit margin of you know Bajaj Auto. I will compare it with TVS. Let's say I will compare Maruti ka operating profit margin with Tata Motors. So you will be able to understand, different companies how they are operating in the same segment, and you will be able to judge that which company is more profitable and which is having less debt, and who's having more liquidity, whose operations are efficient per se. So it is used to compare over time and against industry benchmarks. So first we'll look at profitability ratio. So first ratio of profitability is PAT margin. So PAT margin, it indicates net profit as a percentage of revenue. So consider your profit after tax. So we will have a figure that net profit from P&L and revenue that like total income or revenue from the P&L again. So in order to see that how much the end profit is with relative to the revenue, you will be able to achieve a PAT margin. Let's say I'm at the end of all the processing and things, I am able to generate 150 rupees profit after tax. Final profit that I'm taking at my home is 150 rupees, but I'm selling only one bottle for 1000 rupees. So what will be my PAT margin? My PAT margin will be nothing but 15%. So 150 is 15% of 1000 rupees. 15%. Next, we'll look at operating profit margin. It measures the proportion of revenue left after paying for variable cost of production. So the earlier was taking consideration into after all the costs that I'll reduce, after all the costs that I'll deduct from the income, I'll be getting a profit after tax. But let's say in this operating profit margin, I'm not taking into consideration the depreciation, the taxes, because many of the analysts will think that taxes and depreciation is not the part of the business. It is, it is excluding business. It does not depend on the business. It does not reflect the operating profits of the business. So operating profit will be my whatever total income I'm earning minus my total expenditure. Then I'll arrive at a figure called operating income, and when I will divide that operating income with the revenue, then I'll be getting my operating profit margin. So it is slightly different from profit after PAT margins, but this ratio is also significant, and you can you can compare with other companies, other peers, when you're investing in a company, when you're investing in a particular sector, and you saw the valuations of different company, and you can use this as a ratio in order to see which company at the end of the day you should be investing in. Next, we'll be looking at return on assets. So, a business is making income, okay, and it is having some total assets. So, in order to produce my bottle, I had to set up a manufacturing plant. I had to acquire land. I built offices where I can do sales, marketing. So all these were my assets. My employees are my assets. So at the end of the day, all this income divided by the total assets will help me in, assessing what is my return on assets. The higher my return on assets, the better it is, because I'm able to produce more income per unit of asset. That is what this particular ratio is trying to say. So it measures the asset utilization, and it in evaluating efficiency relative to its peers. Next, I'll look at return on equity. So return on equity is calculated as, you don't need to calculate all of these things. You just understand the concept. I'll go to screener.in, and then I will help you in, deciding which are the ratios that you have to select. And at the end of the day, you can just look at the ratios and build your, thought process that that is this the particular right share to invest in or not. But for now, just understand the concept. So it is calculated as net income divided by the shareholders' equity. So it tells us that how much a business is earning per share. So if the return on equity is higher, so in a return on equity is, let's say, 15%, 20%, then a business is doing fairly very good because it is able to generate a lot of income with respect to the amount of money that the shareholders of the companies that they have invested in the company. So return on equity, it measures the return generated on shareholders equity. Next is earning per share. So all these things you will be seeing that why am I taking only net income into consideration? Because at the end of the day, the profitability of the company I will be able to measure the profitability just with the help of income, whatever the income profits the company is generating. And let's continue this EPS. So net income divided by the average outstanding shares. So for example, I had some outstanding shares in the last financial year, and I have some outstanding shares in this financial year. I will to sum it up and divide it by two. We basically take an average of this and divide the whole average outstanding share with the net income. Then I'll arrive at earning per share. So how much the company is earning per share. So if the EPS is growing, so with the revenue, you can see that the company is doing fairly well as the company is able to generate more and more income on per unit of share. So let me delve into the practicality of it. I'll just go to so I've made this ratios ka checklist where you can just go ahead and check if the companies are able to. So first I'll look into the operating profit margin. Let's say IOC, uh, IOC, Indian Oil Corporation Limited. So, and the company is into, supplying of oil and petroleum gas products, and it will be just basically importing all these products from outside because India doesn't produce any of this. And at the end of the day, they'll be charging some money, extra money, in order to provide it and refine it. They will refine it, and at the end of the day, they will be sending it in their petrol pump where we will be filling all those petrols. So you see, let's see what are the ratios that we just learned. So operating profit margin. So operating profit margin of this business will be 9.74%. So 9.74%, but what is the ideal? So let's see what is ideal. So above 15, general threshold will be like I've set all these things with consideration to the industry standard. Actually, it depends on business to business because they are into, which type of business the company is into, that the operating profit margin differs. Let's say because the company is not producing something, manufacturer, if you're a manufacturer, the chances of you having more profit margins are much higher. But at the end of the day, IOCL is not manufacturing as per say, per se, because they are just importing the petrol, refining it and supplying it. So the operating profit margin will be comparatively less. If you will, I'll just duplicate it and let's compare it, IOCL, with one of its peers. So let's say Hindustan Petroleum Corporation Limited. Okay, Hindustan Petroleum Corporation Limited. Let's see the operating profit margin of this company. So if you see, the market cap of HPCL is 76,000 crore, but the IOCL is much greater, I hope. Yes, it's 2 lakhs 36,000 crore. Even though the company is much bigger, they are able to generate more operating profit margin compared to one of its peer, that is Hindustan Petroleum Corporation Limited. So like that you can compare. Like how did I make this? You can just go into the screener and you can just type OPM. So it will be able to give OPM of last year because this will be the current year and you won't be getting accurate figure until unless this year is over. You won't be able to. So you can just go ahead and type OPM last year. You will be able to get it in the screener. I suggest like slowly I will help you in setting all these ratios in your screener so that you don't have to do it manually anything. So now we looked at operating profit margin. Let's see what is next on our checklist. PAT margin. So PAT margin is nothing but profit after tax. So as I was telling you that they are not manufacturing at the end of the day. So obviously the profit after tax margin, because they cannot charge more for a service. I can charge more for this bottle. So the profit after tax margin in case of IOCL is 5%, and in case of Hindustan Petroleum, again, you can see that IOCL is better than in both the things compared to HPCL in terms of operating profit margin and PAT margin. Let's see what is the next. Then it is ROE. So at the end of the day, who is able to get more of income compared to the equity that the people have put in? You see the ROE of IUCL is 25%. So it is actually very good. The 15-20%, a threshold of 15% is very good in case of ROE. And let's see in case of, but here comes the difference. HPCL ROE is 40%, and you see the operating, maybe the PAT margins or the operating profit margins are not better than IOCL, but the return on equity. So that is what investors see. If the return on equity is greater in a company, and compared to all the other things, and they look at the valuation of the company, they will be interested in a business where the ROE is greater. So in this case, I was favoring personally the IOCL, but now I see that HPCL is into much better ROE in this particular aspect. So, and then I'll be looking at the different aspects. But in profitability overall, I would say that the HPCL is winning right now. Let's study the other ratios, and and these things you can actually get in all this. I think, yeah, edit ratios. I'll just go ahead and see what. Yeah, one of the ratios that you need to add into your screener is PAT margin. So PAT margin, you will be able to see that you just have to write this formula into your screener. You can just add their profit after tax divide by sales into 100. I'll again go to screener aspect. Yeah. So in this, you will be able to add your ratio, edit ratio, and click on yeah, you will be able to make a change into this. Let's say, yeah, I want to create a save quick ratio. So these are the ratios that I've created into this particular screener. Let's say you want to add in one, create new ratio. Yeah, and you can create new ratio from here. And in this case, I created PAT margin. So profit after sales. Okay, profit after tax divided by sales. So profit, like that you can write, and you can use the screener. It's fairly good because the industry uses this. That's why and it's actually a good tool to do fundamental analysis. Like that you can profit out, and I want this particular figure into percentage, so you will just write this, so you will be getting the PAT margin. To make it PAT margins, I'll write, okay. So preview, yeah, just write. You don't have to write the description of it. So I think, yeah, profit after tax into say, so this is how you can, create your own ratios. So just one ratio you have to make, other ratios are there in text, so you don't need to worry about anything. Okay. You can just go ahead and add the OPM of, so you can just go ahead and OPM of last year, I showed you that, and you can go ahead with the PAT margin. PAT margin is also available, so you can just go ahead and click on this. I have already have PAT margin, so because of this, it is showing me this. And now I have what another aspect: operating profit margin, PAT margin, and ROE. And ROE also, you'll be able to find it here. you know. Okay, so so I told you, right? You don't need to calculate all these figures. It is already available. You just need to understand the type of business you are investing in, and at the end of the day, uh, like whatever matrix that we have set in our system, that this is my checklist. If the company is, able to do this, if the company is giving good ROE and it's having good profit after tax margins and OPM of last year is better, you can just directly go and see the cash flow of the company, see the debt of the company, and I'll show you like what are the things you have to check actually. है let's dive into another leverage ratio. So the return on assets and the EPS, like you won't be, seeing it, it is not as important, but obviously you should check. You can get the same things from the screener. Leverage ratio. So one of the leverage ratio that actually previously also I was talking about the debt to equity ratio, but let's dive it into again. So the total debt of the company with respect to the shareholders' equity will be debt equity ratio. So the less than one indicates that the company is actually very good. More than one indicates that the ratio I'm talking about. So more than one indicates the company is having more debt as compared to the equity. So 100 rupees I put into my business, but 120 I've taken it from the outside. So that is actually bad news for shareholders, because companies having more debt than the amount of money that all the shareholders of the company have put into the company. Simple. Indicates financial stability and risk. It helps in assessing risk levels relative to its peer. Next is interest coverage ratio. It indicates how easily a company can pay interest on its outstanding debt. So if a company is having, interest coverage ratio 45 or more than 10 or 15, that shows at the end of the day that the company is having enough earnings in order to repay its debt. So 10 indicates that I have interest obligation of 100 rupees, but I have interest coverage ratio of 10. So I have enough money to repay this particular interest 10 times. That is about interest coverage ratio. A higher ratio suggests better coverage. So in case of any kind of situation like COVID or 2008 crash, the company is having enough financial stability in order to repay its interest, whatever debt it has taken. The company is having enough earnings so that it will be able to repay its debt. Let's again look into the screener, the interest coverage ratio and the debt to equity ratio. Again, let's consider IOCL. So the debt to equity in this case is 0.72. I told you any number less than 1 indicates that it's better. Simple. HPCL in case the now the which side is winning? Now IOCL is winning. So these are the checklist. This is a checklist. I'm just not, I was joking around. There's a checklist that you should see all of these things. And if a company you're trying to invest in, at the end of the day, it's able to pass all those metrics, that okay, the company is having debt to equity less than 1, ROE greater than 20, PAT margins, it depends, but less debt. So the company is having how much debt? 66,000 crore rupees of debt. And the shareholders' equity, I think it's less than the debt of the company. So that's why the debt to equity is greater in case of. So HPCL is a riskier business than IOCL. That's what it is trying to show. And let's see the interest coverage. The interest coverage in this case is 8.22, which is a fairly good number. So the company is having 8 times the money what it has to pay in interest. In case of HPCL, the interest coverage ratio is greater. So now HPCL is having more money, compared to IOCL, to repay its debt, to repay its interest. So it is having 9 times the money it has to repay to the interest. But the debt to equity in this case is risky, and in this case it's less risky. Simple. So now look, now so which side is winning? But according to the debt to equity ratio, but because the company HPCL is having more debt but at the end of the day, it is able to deliver more ROE. So they are using debt in order to, but that's what the ROE number, like in the final verdict, I'll be able to tell you that the ROE number is inflated. So, this much is the return on equity is greater, but at what cost? The debt of the company is much greater than the equity. It's not much greater, but still, the debt of the company is greater than the equity. So at the end of the day, I won't be investing in HPCL even though it's delivering a higher ROE, because a company who's having less debt to equity ratio and still is able to manage a 20% ROE is the best choice for me rather than a company having more debt, and because of that it is reflecting a more ROE. That actually doesn't make any sense. So let's again. So we covered two ratios: profitability ratio, and in the earlier section we covered this is leverage ratio, and earlier section profitability ratio. Let's go ahead and see the other type of ratios as well. In the section three, I'll be covering operating ratios. So what are operating ratios? So operating ratios will show you the whatever the business you are doing, at the end of the day you are having inventory, like you are able to manage your inventory in a more efficient manner, like the efficiency of the company is much good or bad. So the first ratio that comes under is inventory turnover ratio. So the cost of goods sold divided by the average inventory will help you in determining the inventory turnover ratio. Higher turnover indicates efficient inventory management. So the higher inventory turnover ratio will simply show that the company is able to manage its inventory in a much greater way. Receivable turnover ratio, it indicates how efficiently a company collects its receivables, and it is calculated as net credit sales divided by average account receivables. Average account receivables, again, the financial year before, trade receivable of the preceding year, then the last year, preceding before uh, the last year, last year. So last year plus last year divided by two will be my average account receivable, and credit sales. So this is the amount that I have to receive from outsiders. So they are just my debtors, and it shows how effective a company is in collecting debt. So a greater number benchmarking against the peers. So if a company is able to have more receivable turnover ratio, that means it is better than the peers. The company is able to get. So I sold this bottle on debt. I'm still wanting my 1,000 rupees back from my debtors, but my debtors didn't pay me. So my receivable turnover ratio will be bad. But if I'm able to do, let's say, cash sales, my receivable turnover ratio at the end of the day will be much better, because I am able to get all the money and there is no receivable per se. Again, we'll look at inventory turnover ratio and receivable turnover ratio in case of IOCL and BPCL. Yes. So inventory turnover ratio and receivable turnover ratio. So inventory turnover ratio in case of IOCL is 5.33, and inventory turnover ratio in case of, well, in case of HPCL is greater. So the company is able to receive that the debtors come money, whatever it has to take from the sales it has made, they are able to receive more money compared to IOCL. So, and it is fairly a good number in case of HPCL. So that is about interest inventory turnover ratio. Let me look at again the receivable turnover ratio. So average. So actually in Screener you won't be able to do it. Let's go to the company's balance sheet and let's try to calculate it from there. Receivable turnover ratio. So the net credit sales the company has made divided by the average account receivables. Net. So this is the balance sheet of IOCL. Actually, I just opened it just before this lecture. And let me see HPCL ka annual report. So this was for the year 23-24. I think they haven't published it till now, but I'll just see 22-23 ka. They should have published it. I think it'll be coming. The financial year for HPCL can be different from IOCL. So here you can see our ratio was revenue, net credit sales. Actually, it will come into the balance sheet part of a company. Yes. So in case of IOCL, the inventories, I'll just look at debtors, trade receivables. So the trade receivable in case of 2023, I think no, it's 2024. Yeah, is 13831, and the previous year is what it was. Let's just copy this and we'll keep it aside. Just open one. So what you have to look at is the consolidated financial statements. And the balance sheet and this full annual report depends on auditors to auditors and which taxation rules they're following and what is the industry standard right now. So yes, I got the consolidated balance sheet of 22 and 23. I won't be able to compare it with this because this is 23-24. I'll just look at the previous year. There's a single page version as well, but I want to see the full report. Doesn't know you. Yes. Finally, I found it. Yes. So what I was talking about the trade receivables. Net credit sales divided by average account receivable. So credit sales will is nothing but the amount of money that they have, they have to receive from the debtors. So in this year, I'll analyze for the 2023 year. So 16,271 divided by the average of two. So 16,000 plus 18,000, this is around 34,000 crores, and 34,000 crores divided by 16,000 crores in case of IOCL. So 16 divided by 34 will be 47. मतलब, 47 percentage. And in case of the other company for FY23, 6,800 divided by 12. So the average of two actually. So oh, I missed something. Just a second. Sure. So total of this divide by 2 average. So 18 plus 16 is 34. If I'm not wrong, yeah. 8 plus 6 14. 1 2 3. 34. 34 divided by 2 17, and 16,000 divided by 17,000. That's what I'm like. How can this be so much? So it is just around 94 percentage. And in case of this, let's say 6,000 divided by 6,000. You have to calculate. And in this case, I think the company who's better in case of so 6,000 divided by 6,000, actually it's one. So which is higher. So HPCL in this case will be greater, and we saw the same in the other aspect, inventory turnover ratio. So the inventory turnover ratio and receivable turnover ratio in both the cases, I just showed you a rough calculation that in both the cases the company who's able to manage its inventory in a better way is HPCL, and we can see it in the ratios as well, in the both the ratios as well. Let's move to another section. This is valuation ratios, because that ratio was not available into screener. Then you can just check roughly how the both the peers are doing. How I just showed you with the help of consolidated balance sheets. Next is valuation ratio. The first valuation ratio is PE ratio. Most of the companies today people analyze just on the basis of PE ratio, but PE ratio also can lie, because a company who's having, let's say, uh, earnings from other income. If a company sold its plant equipment, and at the end of the day it's the income of the company that in the profit and loss statements that it is showing. So for example, it is having 100 crores rupees of revenue, and because of the selling of plants and machinery, it is able to show that I'm having, let's say, 5,000 crores of revenue. So the PE ratio in this case can be manipulated. That's what I'm trying to say. So it won't give you, like, it is a good ratio, and as per industry, many of the people use PE ratio, but it should not be the only ratio that you should be looking at. You have to look at all these ratios in order to analyze a company. It won't take much time, honestly. Like I'll share you the Word document, and you can just check it, the checklist every time. Tick if the companies are able to, whatever company you're trying to invest in, are able to fall into all these matrices. And at the end of the day, if they are not able to showcase all this performance, and they are below the average performance which the industry is currently having, you can just go ahead and not invest into all those companies. So PE ratio, market price per share. So whatever the IOCL at this price. Okay, sorry. First, I'll cover what are the things that are in this, and then I'll go ahead with the PE ratio in the screener. So market price per share. So whatever is the current price of the per share in the market divided by the earning per share. So the earning per share in the previous section in the earlier profitability, no, yeah, in the profitability we saw that what is the earning per share of a company. The greater the earning per share, the better the company is. So the earning per share should be in uptrend, uh, according to my knowledge. So the P ratio is about the dividing the market price of a share divided by the earning per share. Next, price to sales. So it compares company stock price to its revenue. So whatever, so these valuations are because when you are investing into a company, at what price you are investing into a company. Let's say you found a very good company, but it is highly overvalued. So, in that case, you should not be investing into that company because let's say the defense stocks, the BEL, they are having 45 times the valuation compared to its book value. So they are highly overvalued. The company is having 20,000 crore rupees of revenue, and the market price of the company is 2 lakh crore rupees. And the share price of the company is around 300 rupees. So the revenue, the business profits, revenues, it doesn't justify whatever amount of money the company is earning. We'll look at BEL in order to. I'll show you how the valuation is very different in defense sector compared to any other sectors. So let me, get back to the topic. And price to sales, it measures market price per share divided by the revenue per share of a company. So, if there is a the market price of a share is very high compared to its revenue, that the price to sales ratio will be, much higher. So you don't have to invest in all those companies where the P ratios are much higher or the price to sales ratios are much higher because the price itself of a company, it's not justifying the business it is doing. Simple. Let's look at price to book value. So book value is nothing but what let me introduce you with the concept book value. So at the end of the day, whatever tangible assets I'm having, and let's take into consideration the value of all those assets. And if I subtract it with the liabilities that the business is having, so if you divide if you subtract the figure of the because at the end of the day the book value is showing how much the company is able to if the company will be able to repay all the liabilities it is having. So book value is a very good concept. Let's see it in terms of valuation. So the market value to book value comparison. So market price per share divided by the book value per share. So if the company is having a book value of share of let's say 20 rupees and the share price is let's say 50 rupees. So it is not varying too much. But if the book value of a company is 10 rupees and there can be scenarios where and the market price of a share is 1,000 rupees, so the price to book value will be a very helpful indicator when you're trying to decide the valuation of a company. It indicates how much investors are paying for net assets. So net assets minus the liabilities I was telling you, that will show you the book value of a company. It helps in evaluating the valuation relative to the industry. Again, we'll look at the PB ratios for all these companies, HPCL and IOC. Let's look at dividend yield. So dividend is the amount of I was telling you this concept. At the end of the day, I made some money, and I'm not reinvesting the same money into the business. I'm taking that money at my home. So that will be dividend. Nothing but dividend in terms of publicly listed company. So annual dividend per share divided by the price of per share, that will be my dividend yield. If a company's so there are stocks which are having a very high dividend yield, let's say IOCL and Vedanta Limited. These companies are delivering 20%, 23% of dividend yield per year. The investors who are looking to have a side income can just go ahead and invest in companies who are having more dividend yield. So let's look at all these things into IOCL and BPCL. What is the price to earning ratio? So stock P is around 5 rupees. So actually it is better. The less it is, the better it is, to be honest. And the more it is, the price of the stock is not justifying the earning. And in case of HPCL, this is actually more. So undervalued. You can see the valuation of the companies. Like they are very fair valued company at this particular stock price. You can just go ahead and if you see all the other things and look at the valuation, you can just go ahead and invest into companies right now like that. So the stock PE in case of HPCL is better, and in case of IOCL also it is better. Around five is a very good number. And let's look at other things. Next was our think price to sales, if I'm not wrong. Yeah, price to sales. Price to sales in case of this IOCL is 0.31. The same, the lower it is, the better. And in case of this was 0.17. So which is better? Again, HPCL is better. So you can see the valuation of a company is the company is fairly undervalued. So the price of the share is not reflecting, it's not reflecting the sales the company is making. In case of this is also price to sales is any number below one, it justifies that the price to sales ratio is good. Another thing, price to book value. Price to book value. In case of IOCL is 1.29 and in case of HPCL is 1.59. So now the price to book value actually is greater in case of HPCL. So a company is having slightly, but both the companies are having actually very good book value. Now the what is the book value of the share? If yeah, the book value of the share is 221 and the company share price is 351. Actually, it's a very good company and the book value of in IOCL is 130 and the current price of the company is 168. So comparing both of them, IOCL is better in case of price to book value because the lesser the number, the better it is. And dividend yield. Think dividend yield IOCL is giving 7% per annum to dividend yield and 7 point how much 7.17 and HPCL is giving 7.49. So slightly more HPCL. But comparing all these ratios, you know, slightly both the companies are doing very good, to be very honest. And but in case of HPCL, just because the company is having more debt and it is reflecting it on its ROE, I won't be investing into HPCL, but I will be choosing IOCL, even though it is giving slightly less, dividend yield. The price to sales is actually better in case of HPCL, but and the margins are almost same, but IOCL is having more margins. So the company is having more margins. The ROE is okay less, but the business is less risky. But both the companies, according to full analysis, they are undervalued and you can go ahead and invest into both the companies, but these investment, this is not an advice, this is a suggestion that you should see and do your own analysis before investing into any companies. uh, yeah, so I think we are done with all of this. And I will share you this particular Word document where you will be able to understand all of these things in detail, that how if you can just go ahead and check it that okay, the company is having operating profit margin greater than 15, the PAT margin is greater than 10, RO is greater than 15, interest coverage ratio is should be 3, more than 3, but in both the cases it was more than 5, debt to equity should be less than 1. Here we have written the general threshold. The price to sales ratio should be less than 2. In both the companies, it was actually some zero point 0.1, very good companies. Price to book value, again, price to book value, if it is greater than 3, it's overvaluation. If it's less than 1, it's undervalued. So both the companies are undervalued. The price to earning is in this case because the companies are into different sector, so those you cannot even compare this price to earning ratios, but these companies are having less than 5, PE ratios. So 5 PE ratios actually signifies they are very undervalued company, and according how the business is running. And you can go ahead and see inventory turnover ratio. So 5 to 10 is often considered good, and receivable turnover ratio again 5 to 10 is fairly good. Let me give you a final note. What is my final verdict about investing into a company? The gross profit margin. You should look at the profit margin before investing into a company, but it depends. Again, it depends on the sector wise. In case of this oil, because they are not manufacturing some kind of oil, they are at the end of the day just reselling the oil. So it's not having. Let's say a company. Again, Asian Paints, and I'll take one more example, Berger Paints. Let's compare both these companies on the basis of gross profit margin. So the prof in case of where's the profit margins? Profit after tax margins and OPM. So profit after tax margin is 14% again, but like and OPM margins are 21%. So OPM margin tells us without considering the tax and the depreciation. So the company is able to deliver OPM of more than 20% in case of Asian Paints, and the company in this case, that competitor Berger Paints is not delivering that much OPM. So straight away you can see that which so if a company is delivering a greater 20 a profit margin, so 100 rupees ka paint it is selling, the company is able to make 20 rupees. That is about operating profit margin. So Asian Paint in this case in the same segment is able to make more money compared to Berger Paints. Simple. So final verdict continues, and revenue should be in uptrend. You should see in the balance sheet and profit and loss statement. You can just go ahead and screen it also. The revenue of a company should be in an increasing order. So sales 5,000, say how much went? It went to 8,000 nine. Sorry, sales, yeah, 10,000 crores to 35,000 crores. That is the sales. So it is in fully uptrend. I think in case of budget paints, it should be fully in uptrend. Yeah, 3,000 crores say full. So the companies should be having, upward revenue trend, upward net profit margin. Both the companies should be having, yeah, from 200 crores to 1,000 crores, from 1,000 crores to 5,000 crores. So these are the companies that you should be looking at. And let's say the debt should be sustainable, and the interest coverage ratio. So let's see the debt and the interest coverage ratio. Will the company will be able to repay the interest and debt? So the debt in the case of Asian Paints, the interest coverage ratio is 32 times. So they have 32 times the money, and they have to pay in interest on the loan that they have taken. And this case they have 20 times. So yeah, in this case that Asian Paints is better, obviously. Yeah, debt. The company is having less debt. I think that's why 2,400 crores. The company is having no. Actually Berger is having less debt, and still they are having less interest coverage ratio. So maybe Asian Paints is a good deal, and like that you have to see. Okay, and final verdict, more document, and the ROE of the companies should be 20-25%. So what is the return on equity? So Berger is having again 23% better. This is having 30% ROE. Again, more better. So if the company is having 20%, more than 20% ROE, better. Good to go. Again, the business diversification. I think both the companies are into, they are into plaster, putty. What they are having products, but they are not, widening their this product base. So if they are having a particular, the companies who were successful, who became multi-bagger, they at the end of the day were having less number of products. They were not diversifying their products. Like, okay, Adani is having a lot of products, but at the end of the day all those stocks were multi-bagger. You can argue that. But if a company is having some kind of niche, and they have specific product lines, and they are not, because if you are putting focus on 5 7 product, different products, at the end of the day the consolidated sheets will not be able to show, the profits, because some business is making profit, some business is making loss. It won't justify the, the type of business that you're doing. If you're choosing some stocks, which you want them to be, giving 200 500% return, 10,000 1000% return, Choose companies who are having less business diversification. Be very patient, very patient, because this is about long term. The stocks might, might not perform 1 year, 2 year, 3 years in a down cycle. And at the end of the day, you should not lose hope. If you're trusting enough, whatever you did your analysis on the company, and you think that like whatever I did right now, what I taught you is worthy enough, and you think that all okay, the business is doing fairly well, maybe the valuations are not justifying it, and maybe it is undervalued now, but in the future people will see its value. And trust me, big businesses takes time, and you have to have a lot of patience when you are investing into a company. And you should average, be if it is going on higher side, average, lower side, average. If you're believing enough on a business, you should be continuously investing into a particular business. That's what my take is. And we are done with full fundamentals. In the next series, we'll be watching like how what are futures and options, how to hedge all these all these investments with the help of this, and how you can make short-term money out of futures and options. So I want to suggest two books if you are more interested into learning how to analyze like how to choose stocks which are worth it and they will be giving good returns. The Little Book of Valuation by Ashwath Damodaran, and the Little Book that Builds Wealth by Pat Dorsey. And thank you very much for watching. And if you have any doubt, please do let me know. And stay tuned for more such videos.